Well, good morning, everyone. Thank you again for joining us to hear from Dr. Robert Eiler. As always, the chat feature is available to post your questions, and Dr. Eiler will address those at the end of his presentation. Thank you, Dr. Eiler.
Thanks, Vicki. Folks, thanks for coming today. What we're going to do is we're going to move you through where the latest and greatest data are showing us we're recovering and things are looking pretty good. I got a few caveats to some of the forecasts that are out there and some things to think about, but generally speaking, we are moving through the summer relatively well thus far. And here we go. So latest data for the US came out about 10 days ago. And they basically tell the same story they've been telling for the last few months, meaning if you look at the way that people have been unemployed, the folks that are temporarily unemployed have faded quickly as we expected as economists, and those that are permanently unemployed picked up a little bit as there were some conversions of temporarily unemployed people to permanently unemployed. But that total is the core of the number of people that remain unemployed going into the end of this year, and we will see how much more that fades. But the reason I show this is because if we want to compare this to the Great Recession, which is looking back to where that larger blue hill is about a quarter of the way moving left to right, notice that the sum of those two parts is just a little bit under 5 million people. When the Great Recession was getting into recovery period and we were actually at 5 million people unemployed again, that was about 2013. So you can see moving left to right, the big hill, the peak of the Great Recession, the slow recovery period, about February 2013, or right about the beginning of 2013, as we were at the same level. So if we think about it, as I'll show you in a little bit, we still have some ways to go to get that number of people re-employed in the economy, get back down to the numbers we were pre-pandemic, which you can see where it says February 2020 and those relatively low numbers before the bump. But number of people that completed temporary jobs and are now looking for jobs is added to this. A big bit of recent controversy has been around the folks that have left their jobs or quit, and I'll come back to this at the very end as yet another workforce development challenge. These are folks re-entering the workforce, and these numbers remain relatively steady historically, but we've seen it pick up over the last few months as people are starting to think about getting back into work as their kids' schools are reopening, their kids' childcare is reopening, and their unemployment benefits are starting to be less robust. And this is folks that are new entrants, meaning generally high school and college graduates. So the sum of those parts is the total amount of unemployed. Notice again, walking back, it's actually a little bit better than February 2013 when you add those other parts, which is good, meaning that we're recovering in some ways a little bit more quickly, but we need to watch the total, really the core, the blue and the gray here, how they fade over the next few months. That's really going to tell the ultimate tale of how we recover and the speed at which we get back to pre-pandemic numbers. So let's look quickly at the industrial changes in the US. This is April 2020 compared to January 2020. So this is the first big month of losses of jobs. And the American economy started to recover, except for a couple of industries, right away in May, but not quick recovery. If we now go to the end of the year 2020 and compare to the beginning of the year, you can see that only in transportation, that little green bump in the middle of the page above the red dotted line had seen positive aspects in terms of job gains, and that's mainly because we moved our lives online and we saw a lot more logistics come into our lives because we had a lot more delivered to home. But on the far right hand side, bars and restaurants, food services and drinking places, hotels still had a lot of suffering, even though there had been some recovery. April this year, May this year, June this year showed continued recovery versus pre-pandemic numbers. But on the far right hand side, again, a theme that exists in California and most of the Western United States. Hotels are still down about 22%, meaning 22 people out of 100 that had a job January 2020 do not have a job in that industry, and those jobs have not come back yet. So we're watching hotels relatively closely, especially through the summer months, because what we don't want to have is we don't want to have structural scarring or the issue or an aspect where some capacity in that industry is gone for a long period of time. We're watching it close. Another thing we're watching close is inflation. So latest data on inflation just came out, and you can see here the evolution of two measures of prices, all of them wrapped around the idea of so-called personal consumer expenditures. or personal consumption expenditures. So the red line is the more important. That's core. That's after food and energy prices are taken away. But I'll make the case in a minute that the total also has some aspects. It's a lot more volatile. As you can see, the blue line wrapping around the red and having a lot more ups and downs. But the red line, the core, is the one that the Federal Reserve's watching closely, and is also, in a sense, what you might hear in the news is trimming the average a little bit to try to get a lot of the episodic changes out of their thinking in terms of policy. But as that red line shoots up, it is somewhat historic, only in that right after recession, we do see prices kick up because supply chains get a little problematic on the edge of recession going into recovery. This one has been a little bit more startling because it's so vertical in its climb rather than climbing over a few months or over a few quarters. It's grown over the last few weeks. So we're watching closely to see if that actually starts to fade a little bit. And actually, there are indicators it is fading a little bit in terms of not growing as fast. But the four things to remember is that we've seen things like gas prices, which is really more part of the total than the core. But gas prices become part of the core as they leak into supply chains and into costs of delivering goods and services. So we don't want to forget that food and energy prices do have an effect on other goods and services in terms of their costs. The auto supply and what's been happening with semiconductors and being able to move more and more new cars off the assembly lines, some of that is also just post-recession, early recovery, low interest rates demand, keeping demand relatively frothy against a relatively low supply. So we're expecting the auto industry to sort itself out over the next 6 months, but that also is driving some of that price increase because as we look more to buy cars while they're getting as good with low interest rates, we're seeing those prices pop up. We have to remember inflation is a regressive tax. So for our lower income households, especially those deciding about going back to work, what wage they will accept will depend on how they see their local cost of living. And for better or for worse, local cost of living is generally driven by housing prices. We're now hearing rents are stabilizing and in fact going back up slowly in our urban areas, in some urban areas relatively quickly as people are slowly remigrating back to the cities, assuming that they're going to be coming back to work relatively soon, and in some cases being told that they need to come back to work. So we might go through yet another housing scramble in terms of rents, where people are deciding to live. But I'll come back to housing in a minute, thinking about the costs of buying homes and the ideas of what's happening with the forecast in just a little bit. But keep that in mind that local cost of living is driven a lot by housing. National cost of living is driven a lot by other parts of what we buy, primarily fuel and cars and other large durable goods. The latest forecast looks good. This is from May. This is coming from a survey of 40 forecasters that the Philadelphia Federal Reserve Branch surveys every quarter. And the first column of data called previous is what they said 1 quarter ago, meaning right after the first of the year. The new one is what's happened as of May. And you can see a lot of those numbers have bumped up significantly in terms of real GDP growth through the next few quarters. And you can see that in this first shaded area. For the unemployment rate, you can also see that they've gone down somewhat, not as appreciably as the growth rate of GDP over the next few quarters, but have gotten a little bit more speedy in terms of getting us back to pre-pandemic numbers. Over the next few years, growth is likely to moderate. This is also classic in a recovery period where you have a big bump initially because you fell so far the previous year, and then you see it moderate because you're getting closer and closer to what we call full capacity of the economy, and the growth rate naturally slows down as we use up more and more resources. Unemployment is one part of that story, meaning the more and more we get closer to full employment, the less and less growth we're going to get out of the economy. But all these numbers look good in the sense that we're seeing a more speedy comeback to pre-pandemic numbers. And we also believe that a lot of the federal stimulus and low interest rates are helping to fuel and propel some of these growth rates, which is good. The CBO, or the Congressional Budget Office, just released their latest updates, and they're kind of corroborating these in the sense it's about 6.7% growth for 2021, 5% growth in 2022, but then very moderate growth, meaning that if you take the first couple years, 2021 and 2022, and make them a little bit bigger, it's basically stripping 2023 to 2025 of growth that otherwise has been predicted. But that story overall is very solid. The one reason why they're expecting after 2023 to have a slowdown is they don't expect the labor force to grow this quickly. And that's because we have, in some cases, baby boomers who have now fully retired. And there's a shift happening, at least predicted in the labor force, that we won't see those workers necessarily come back in as productive as they were pre-pandemic. And think of it this way. If in 2019 you were 70 years old and you had a job and you were basically at the same salary you were, let's say 4 years before that, 4 years go by and the labor market is going to shift. So we have to think if there's a large cell of people who are in that 65 to 70 year range pre-pandemic, 3 or 4 years go by, now they're suddenly 70 to 75. Will they come back, or will they take equity market gains, other gains in terms of their housing wealth, convert that into a larger amount of retirement income, and finally make that decision? That's part of these descriptions in terms of the forecast going forward. Also, inflation is meant to be the highest this year and then start to moderate. So what you're hearing in the news is that inflation is moderating or will moderate after this year. And a lot of it is classic post-recession cleanup of supply chains and basically policy boosted demand. So we're watching this closely to make sure that if there's any changes in this, we want to say, okay, what's really going to change quickly? And the idea is on inflation, we should not expect inflation to really take off unless some geopolitical event takes place that leads to a constriction of resources. Everything else is basically in place, fiscal stimulus, low interest rates, to propel these forecasts forward. So far, so good in recovery, more or less. Now, if we think about where we are in terms of getting back to pre-pandemic numbers, one thing I like to do is compare where we were with the Great Recession and the timeline to where we are now, because a lot of questions get asked about how quickly we're going to get back. That red dotted line is basically the get back number. So if we start the Great Recession in November 2007 at 100, it took about 78 months seasonally adjusted to get back to that same volume of workers. This is where we are at the end of June with respect to COVID-19, 95.7% back to January 2020 levels of employment. So more or less a modified V-shaped recovery, even though that right-hand leg of the V is, and if you've been watching these over the last 6 or 7 months, I've been talking quite a bit about how this recovery was more likely to be a modified V than a straight V. That right-hand leg is starting to flatten a little bit. We should expect it to flatten a little bit more. In probably another 12, 15 months, we will cross that red dotted line about 18 months faster than was predicted 1 year ago before the enormous amount of fiscal stimulus took place and basically helped propel a lot of the gains. And also, with the use of the vaccines and opening up the economy more completely, all that's coming together to get us back to that red dotted line. But we got to get back to that red dotted line before we talk about anything else. Here's California in contrast. California took about 68, 70 months to get back to where we started the Great Recession. And this is where we are as of the end of May. The June data come out on Friday. And we're expecting that to pop up a little bit closer to 94, maybe a little bit over 94, but 93.6% back to where we were in January 2020. We need to get California volume of workers back up to that red dotted line. But notice it's a little bit more jumpy than the national level, in that California policies have been more of a turn on, turn off policy rather than, let's say, a slow evolution through COVID-19 and the social policies to open and sometimes modify how open the economy was. But we seem to be on the right track and we're moving. But notice how flat that has been over the last few months. We're in a lot of transition periods in terms of workforce, which I'll come back to in just a minute in California. If we look at the data that came out in May, looking at industries, very similar picture to the national level we just saw earlier. You'll notice if you compare to January 2020, every single industry got cut in April 2020. May 2020, there was small positive changes in some industries. Other industries saw a little bit more harm. By the end of the year, we'd seen recovery. Again, notice about basically in the middle of the page, transportation, warehousing, and utilities. The predominantly logistics, transportation, and warehousing, positive growth in 2020. Every other industry basically negative. And then we see April 2021, or March, I'm sorry, April, and then there's May. So in contrast to the US, if you look to the far right, leisure and hospitality, other services are really the big losers. Now, we said earlier that accommodation and restaurants and bars, basically the combination is leisure and hospitality, also saw the most harm at the national level. But for California, because there's specific ways in which we have either closed or more slowly reopened than other parts of the United States, those industries have really taken on the brunt of the harm in terms of the loss of jobs. So that 25% means that a quarter of the jobs that were there in January 2020 aren't there right now in those industries in terms of being filled jobs. That volume of workers is down to 3/4 of what it was January 2020. In other services, hair salons, nail salons, fitness centers, nonprofits not associated with healthcare, 80% of the volume of workers that we had pre-pandemic. So those are really, when you think about workforce development challenges, it's in those two industries where most of the challenges still remain, though we have negative numbers almost across the board still as of the end of May. There's workforce challenges everywhere, but those two industries are very focal. The government piece is something that's still very mysterious. Economists are sort of betting on the idea that that 8% is predominantly retired workers, and whether or not we see something coming back is a big challenge going forward. But the state budget gaining access to federal funding, being more robust than we expected, the next 12 months will really tell the tale of whether or not we see employment really come back or not, because it could be a lot of state agencies and local agencies decide not to rehire for retired positions across the board, and thus we may see that negative number stick for a little while longer than in other industries. Let's shift to housing. So if we compare the last 2 years in terms of price change, last year was an amazing year in housing. Notice though, San Francisco, you can barely see anything, and it's because it was barely negative. It's basically zero change over an entire 12 months. And urban areas generally had a lot of positive and negative movement over the last 12 months, where places like Los Angeles really didn't change that much in terms of how the composition of the housing market shifted versus other areas of California. San Francisco was really an anomaly. But if you look across the board, and these are basically sorted alphabetically as just some selected counties to try to get the largest geographic coverage on one graph, not a whole lot of differences, though you can see in places like El Dorado County, Imperial, Riverside, San Joaquin, relatively robust against the state average, but other ones that are relatively urban also saw pretty robust movements. And a lot of this is renters moving into housing while interest rates are low and the getting was good. Some folks leaving the urban areas and going to less urban areas, but really it was not focused on any one geography. It really was across the board, where San Francisco again was a standout anomaly, as was San Mateo County, which I don't show here because it's basically repetitive of San Francisco. This is the 2-year run. So you can see that if you think about the last 2 years, this last year was really where the growth was driven. And it makes you kind of think about, okay, two ideas. One, is it sustainable? And to a certain extent right now, the demand and supply characteristics in housing suggest it is still sustainable, in the sense we should not expect to see a gutting of the housing market anytime soon. We just don't have enough supply. The second question is, are there specific geographies that we should expect to see some shifting? And the answer is, well, in San Francisco, especially if we see employers asking workers to come back to work, we're likely to see a little bit of a boost there. Otherwise, it's going to be sort of moderate. And here's the forecast over the next 12 months. And I try to show more counties here. In fact, I'm trying to show every single county in California. If you look at the far left, the average change in California is 9.1% over the next year for housing prices. Tuolumne County is the highest for right now at 12.6 over the next 12 months. Mendocino County at 3.6, two relatively rural counties, bookending the counties in California in terms of growth. But the idea here is in California, the housing market, regardless of what you hear about population movements, still looks relatively robust over the next year. These are through the end of May. So positive growth in California in terms of labor market continuing, housing prices relatively stable, if not continuing to grow over the next year. And everything looks good for continued recovery in California. And this is true for most of the Western United States. But one workforce challenge to think about is people quitting. So this is big news. And every month or every time we do these webinars with Chabin, I try to think of something that is maybe in the news, that is a policy issue that if you're on today and you think about, okay, where maybe I want to focus my effort over the next 3-4 weeks, thinking about the quit rates, because it came up in the news, is something really I'm letting you know is don't get too wound up about it. So it's made a lot of news, but the aspect of it is really job matching. So if you have more people quitting than you expected, and quits are up, as I'll show you in a minute. Here's the graph of quits across California from December 2000. This is in thousands of workers. So think about the evolution since December 2000 and the total number of people working. I did not normalize this by the number of people working because quitting is something that should be an anomaly and not the norm. So notice it basically follows the pattern. We go into recession, less people quit. We crawl up the ladder. People are job shifting. They're trying to match themselves to their job more completely as jobs are available. Recession happens, people quit less. You can see that evolution. You can basically see the recession since December 2000, the two, and then the third one coming up relatively easily. Looking toward the far right, big cut in people quitting as we got toward the beginning of the recession. Then we saw people quitting going up. Part of that's because the unemployment benefits became more robust. And by having more robust benefits, it allows you, especially if you can gain access to them by quitting, an incentive to walk away in the short term. Now, not everybody who quits is going to gain access to unemployment benefits, but it's something that we had a little bit more looseness around the rules. It's somewhat similar to what we saw at the end of the Great Recession, but actually a little bit more robust. And hence you saw more of a spike in those quits. But if you look at the far right-hand side, which I'll now shade, it's faded a little bit. So while the unemployment benefits were more robust and available, a little bit more incentive to quit if you feel like, okay, now is the time. But at some point, people need to eat. So quitting, again, is something that is an anomaly and not the norm. And don't look at the news and say, oh, God, the quit rates are up. There must be some weird shift in the labor market happening. That's not true. It's anomalous and short-term in nature. Do not expect, if I show you these data a year from now, they're continuing to shoot up vertically. Doesn't make sense in a labor market for that to happen, especially one in which you're seeing a recovering economy. You'll see it take on more classic characteristics where the quits are slow, steady, and sure and on a trend and really not deviating from the long-term mean. But something to watch. There's no obvious pattern there. Leisure and hospitality and other services, those sort of personal services where you're closer to your client, have seen a little bit more percentage change in quitting, but they are not the predominant industries in which quitting is taking place. It's actually very spread around the industries, and that's exactly the way it should be. It just happens to be a little bit more voluminous for the time being. Okay, so what to watch? One, inflation is out there. It's classic post-recession. It's a little higher than we're expecting, but everybody who watches this every day of the week, meaning economists who are forecasting the US economy, suggest that all the data are telling them it's going to moderate. Looking at medium-term bonds, so 10-year Treasury securities have seen a lower yield levels over the last month or so. A lot of that's driven by inflation forecasts looking at lower levels of risk. So we'll see how much wage holdouts continue, because wages rising can also exacerbate inflation pressure. We'll see how much longer that can happen against people trying to get back into work. The cost of living regionally is something to watch. So if you're thinking about what's going on with housing prices and how that's going to affect people coming to work, coming to your area to set up, basically to establish roots, how economic development connects to local housing costs. One of the biggest issues over the next 5 years is going to be, do we build housing with the idea that people are going to come because the housing availability drives workforce development and ultimately economic development, or is it the other way around? Meaning, do we have to figure out what industries are going to be here locally and the types of workers we need, and then establish a housing plan to sort of match against what we expect those new workers and those new industries to demand? Very nasty question. It's age old, but it's now again kind of springing up in policy circles around the state and around the Western United States specifically, given the increase in housing prices. What do you do next? Will we see more variants? In other words, as we get closer to fall and winter, will we see a spike in cases that then causes a policy concern at the state or at the national level about slowing down economic activity for a couple of weeks? It'll be very intriguing to see if that happens, but watch for that closely. We're already seeing it in some other countries. If that happens, this recovery may not keep the momentum going through the end of the year as well as it's going right now, but should clean up again after, let's say, spring, if in fact we do have relatively problematic movements through fall and winter with respect to an increase in cases. Thus, we need the economy to stay open, stay safe, and stay the course. We need to get the entire economy back open and really just getting people confident that it's going to stay open. That's a critical factor in economic and ultimately workforce development. So Vicki, with that, I'll hand it back over to you to take questions. I don't see anything in the chat, but folks, thanks again for coming. And I want to thank Chabin for continuing to sponsor this.
Okay, Rob, thank you very much. That was good. It's good to hear that things are looking up for the summer. I hope we can keep that trend going. Yeah, I don't see any questions now. So we will thank you. If you have any questions that come up later, go ahead and send them to either myself or to Rob. We've got our emails there on the screen. And also this will be available. It has been recorded, so it will be available on the website a little later on today. Thank you.
Thanks for coming, folks.